Federal Reserve officials downplaying the impact of a weak U.S. dollar. Dallas Fed President Richard Fisher says it's only one of the factors the Fed watches when setting policy, and Philadelphia Fed President Charles Plosser says he's not worried about the dollar's behavior. Here now is Jim Rickards, Senior Managing Director of Market Intelligence, and obviously we have Mike and Larry are still here. Jim, the President was in China for a while, a lot of coverage. How'd it go?
I thought this was the worst sort of foreign summit trip by a president since probably 1961, the Kennedy and Khrushchev fiasco. This was like
kitchen thing.
Yeah, it's like going. Well, that was Nixon.
Oh, that's right. Yeah.
Yeah, but no, this was a lot worse. At the end of it, Khrushchev said we're going to start a war, and Kennedy, in effect, said bring it on. He said it's going to be a long, cold winter. Turned out they didn't have a war, but that ended in total disaster. This wasn't quite that bad.
Quite, yeah.
This is like going on vacation and it rains for 5 days, and you just wish you'd stayed home in the first place.
Weren't expectations low? How do you know what the New York Times?
Well, when the New York Times says they're disappointed, you know it was probably
so you know
a lot,
that for them to concede that it wasn't great means it was really bad.
Right. A lot of the commentary is we didn't have high expectations. The president strengthened his relationship with Asian leaders, created a lot of goodwill. So that was sort of the positive version of it. But it was worse than neutral. Think of all the sort of things that blew up while he was there. Copenhagen is dead. You could see that coming, but that happened while the president.
Is that good or bad? No.
Well, my own view is it's probably good.
Yeah.
But, good for the economy, but that blew up. Medvedev gave him, looks like the Russian missile treaty is going to be allowed to lapse. Medvedev gave him no help on Iranian sanctions. Who gave the president no help on Iranian sanctions? Who gave the president no help on the yuan dollar issue, which is probably the biggest single issue while they're out there? No progress on their free trade agreement with Korea. I mean, the APEC communique was going to mention something about market forces affecting the dollar. They took that out at Chinese insistence at the last minute. He shakes hands with the Myanmar generals. No mention of Suu Kyi, and so it's just a lot of disasters along the way.
Doesn't sound good. We had someone on earlier, or maybe it was in the copy, that it said, "What's wrong with the dollar going back to where it was before the crisis?"
Well, that's certainly Bernanke's view. He's actually quite relaxed about the dollar. He says, look, we're nowhere near the all-time lows. We're kind of back to where we were, 15, 18 months ago. Between 1985 and 1987, the dollar went down 50% after the Plaza Accords. So they look at that and say, we've been here before. This is just a normal. We do this every 10 years or so. We did it in the 70s. We did it in the 80s, et cetera. My own view is that it's a much more unstable and dangerous world, that we're not doing it in the same environment we had in the 1980s. The biggest single difference is in the 80s, our creditors were Japan, Europe, and the Arabs. All three of them are utterly dependent on us for their security, for their national security. Our national security is their national security. China is now the creditor. They don't depend on us for our national security, so we don't have the lever to keep them in line economically and, in effect, force them to buy Treasury securities, for example.
But they depend on us to buy all their stuff.
They do, and it is a very important two-way trading relationship, but all the more reason from their point of view to keep the yuan pegged to the dollar. They have no interest in revaluation now. Eventually down the road, we have a massive interest.
We do want.
Yeah, because you look at the formula for GDP, consumers flat on its back, business investment picking up a little bit, but that's very dependent on the consumer who's going to build new plant and equipment unless you've got sales, although the export sector might benefit from that. Government spending has been propping up the economy, but it's completely non-sustainable. That's recognized. And so what's left? Net exports. And so if we can bring... well, we want to get some exports going to China, but the key to that is to devalue the dollar.
Right, that's what I mean. But we love our cheap stuff from Walmart, though. That's my point.
Well, right, but we also love our economy and we love our jobs. And so if there's nothing else that's going to get the economy going, you get a business investment in the export sector, increase in exports. But here's the catch-22. China has got the same problem in reverse. Their exports are down 20% in the last year. They are, I've said for years, they are not economic players. They are political players. They're communists, and they're worried about the political stability and the perpetuation of the regime. They got 10 million people a year walking into cities saying, give me a job. They've got to provide those jobs. So here's the catch-22. China is saying, in effect, we'll revalue the yuan when we see exports pick up and a little action in the U.S. economy. The U.S. is saying, you're not going to see those things unless you revalue the yuan. So this kind of reminds me of, Bernanke's trying to break the Bank of China. This reminds me a lot of Soros and the Bank of England in 1992, where they were trying to defend sterling, and Soros just said, I'm selling sterling. Bank of England bought it until they finally broke. Bernanke's saying, we're just going to keep selling dollars, run the printing presses 24/7, and China's sitting there buying all the dollars. The difference is, in order for the Bank of England to defend sterling, they had to sell dollars, and they had a finite supply of dollars. So Soros just said, I can short sterling longer than you can provide dollars, and so I'll break you, and he did. China, what's the short when they're buying dollars? It's the yuan. It's their own currency. They can print it and they can force it on their own people. So they have an unlimited supply, unlimited capacity to go short. So this is basically a game of chicken between the two biggest economies in the world. The irony is each country is shorting its own currency. In fact, Bernanke's selling dollars, China's selling yuan. I don't want to be in that trade. I'd rather just buy gold and go to the sidelines and let these guys fight it out. Yeah.
So that's why gold's going up.
Well, it's one of the reasons. I mean, gold really has these $100 moves are important to traders. They're not trivial, but gold, when it's not moving on a monetary vector, it's moving on supply-demand fundamentals, a fear trade, and an inflation trade. But very few people think of gold as money. The minute you think of gold as money, that level is, it's a range between $4,000 and $11,000 an ounce. That's the price gold would have to be to support the money supply. I talk to people about gold, and they say, well, there's not enough gold to support the money supply. And I say, well, of course there's enough gold. It's just a question of price. At what price would you have to peg it? And if you really, I'm not a deflationary hard dollar guy, but if you're an inflationist, which basically the entire American Economics Association, if you really want to inflate the dollar, just conduct open market operations. Have the Fed conduct open market operations in gold, and you'll be a buyer, and the gold will find its level, and the level's at 4,000, and that's a 75% devaluation of the dollar.
So you just had some people, some of our viewers just went right to heaven on your 4,000 to 11,000.
I like that Rickards guy.
This is what FDR did. FDR confiscated gold at 20 and remarked it at 35 as a 75% devaluation in a deflationary environment.
Yeah, we're out of time.
Really quickly, your most aggressive target on gold then? You said you've been a bull on it for a while.
I haven't. I see $2,000 without breaking a sweat. That's on fundamentals without treating it as money.
In 2010? In 2009?
2010. I mean, it's going to move there. It might gap up, go up and down a little bit. But if it gets this monetary vector, people actually say gold is money. That range, depending on how you calculate it, is $4,000 to $11,000 an ounce. Basically, it's eighth grade math. Take the gold supply divided by the money supply.
Wow. That would be news.
What about can the S&P go along? They usually are about the same.
Well, it's nominal dollars, right? Because if the stock market's up 30% and the dollar's down 30%, how much did you make?
Wow. I'm going to call G. Gordon Liddy right after the show. He sells that. Remember, I buy my gold from, all right, thank you.
You're welcome, Jim.
Thanks, Jim.
Thanks.
Wow. Still to come.